often called being underwater on a loan, negative equity, is a common financial situation that occurs when you owe more than an asset is worth. This term describes the gap between your remaining debt and the current market value of your property or vehicle. Imagine owing $40,000 on a car that is only worth $20,000. That difference is the negative equity you must cover. This often happens when an asset loses value quickly, or if a borrower takes out a loan with a very small initial down payment. Positive equity builds your wealth, while negative equity acts as a financial anchor that can restrict your future choices. As you can see, the loan balance remains higher than the market value, which creates the deficit that must be addressed before selling. The best way to resolve this is by paying down the loan faster than the asset depreciates, or simply waiting for the market to recover. Understanding your equity position is key to making smart long-term financial decisions. Thanks for watching, and remember to check back for more basics.